morning to everyone. My name is Seamus McCaffrey, practicing accountant in Omagh, County Tyrone, and our practice started in 1982, and a wide range of clients mainly in the farming world, in the agri-food world, and quite a number in Scotland and the north of England. And the reason for that is there was a time when it was, from a financial point of view, a very profitable thing to sell your land in County Tyrone and move across to Scotland. So a lot of our clients are around Dumfries, so you sign for Dumfries House quite regularly. The topic is succession planning with a bit of inheritance tax. It's a fairly short presentation, and please feel free to ask questions, share your views as I go through the presentation. When we talk about succession planning, we're not talking about retirement. We're talking about something that's positive. We're talking about ensuring the continuity of the family farm, ensuring the continuity of the wealth, the skills, the know-how that has been accumulated for many, many years. It's about this word sustainability. It's about evolution, and it's about future-proofing. And when we meet our clients twice a year to talk about tax matters, succession planning is now always on the agenda because it is such a key item. And the techniques, and there's nothing magic about these techniques, there are a lot of very sensible, practical things to do. 2 names on the business bank account, 2 names on the flock number, the herd number. The importance of having a will made, and I'm not being sarcastic when I say that we have to remind some of our clients that a will is only an effective will when it's made with a solicitor. There are those that imagine you can print a will off the internet and that's a will, and that can be an issue. The importance of appointing 2 executors, and the importance of considering whether or not we should have a power of attorney, depending on our health. And where we have, in a situation that is likely that a son or daughter may continue in the farm business, then the importance of considering pension planning. So, running the farm, my son or daughter is likely to take over that farm, then it's important that perhaps I should start paying money into a pension so that at some stage in the future I can become less financially dependent on the farm by having a source of pension income coming in. And it's fairly usual that in a lot of farming situations, a simple thing like perhaps the rest of us consider to be second nature to have a pension plan in place, there are a lot of farm families who do not have a pension plan. So there's practical things like that, and the benefits are enormous to doing those simple things in terms of maintaining harmony within the family, encouraging the enthusiasm of the young people to the farm, and very importantly, saves legal fees in the event of a dispute. So those are the principles of succession planning, and as I say, which we'll be talking about now in a minute, the announcement last October by the Chancellor of the Exchequer in relation to the proposed changes in inheritance tax has given a bit of a kickstart and has moved succession planning up the agenda. And we notice now when our clients go to talk to their bank in relation to getting additional finance for the farm, succession planning is now on the agenda when they're talking to their banking relationship person. So a key issue, the whole issue of succession planning. And moving then to talk about inheritance tax. And as we all know, there are the basics of it. It's a tax on wealth, held at the date of death or 7 years prior to death, and There are two rates, the 40% rate on death and a 20% rate for lifetime transfers. And in the 7 years, it's a sliding scale between 20% and 40%. Transfers between spouses, there's no inheritance tax. And transfers made more than 7 years before death, no inheritance tax. And then we have a range of exemptions. The first standard exemption is that each person has an exemption of £325,000 for their lifetime. There is a residence exemption for your principal private house. There is an exemption there of £175,000, provided that your total estate is less than £2 million. And then there are further allowances. Each year, a person can gift £3,000. Secondly, in or around the time of marriage, a parent can gift £5,000, and anyone else can gift £2,500. And the last one there, if you can make gifts out of income, those gifts are exempt. But the key point about that one is that the onus of proof is on the person to prove that, first of all, the money is going out of their annual income, not from capital, and secondly, they still have enough money left to live. And there's quite a piece of paperwork to be maintained to discharge that proof to HMRC. No, the upper ceiling is, as I say, the money each year must come out of income. It can't come out of capital. And secondly, you must have enough money left to live. So those are the ceilings. Now, for example, if this year I have a pension, and as you may know, I can take 25% of my pension out tax-free. If I did that, that's not income. It must be recurring income. So it's quite a tight one. It looks a very simple exemption, gifts out of income, but as I say, I've written after it not capital, and I should have put after there, I suppose, just extra conditions in terms more of paperwork. So those are the exemptions, started the exemptions. And then, as you know, we then have two big ones. We have the agricultural property relief, which is at the rate at the minute of 100% to cover the agricultural value of the assets on our estate. And if the farm has diversified into something else, say holiday lets or some other business, and that's a business, then there is business property relief, again at 100% to cover the value of the business assets. So at the minute, as I say, I'm a farmer running the farm. I can gift to the next generation and get 100% agricultural property relief, provided I can prove that I'm farming. And likewise, if the business has diversified into something else, then there is business property relief at the rate of 100%, provided I prove that I'm running a business. And that proof of whether I'm running a farm or whether I'm running a business, the best practical proof is the annual income tax return each year. So the annual income tax return, which we file each year, is a very critical, important document from the point of view of setting ourselves up to make ourselves available for the agricultural property relief or the business property relief. Because in practical terms, what happens is that if I pass away today, the executors of my estate will be claiming agricultural property relief or business property relief. And what happens in practice is that HMRC looks back at my annual income tax return for the last 2 preceding years. And if it's clear from reading that return that I'm a farmer or running a business, then generally speaking, agricultural property relief and business property relief is automatically granted. And I think that is the present position. Then, moving forward, as I say, the 100% applies up to April 26. But from April 26, it is proposed, from last October in the Chancellor's statement, it is proposed that the £1 million is going to apply to a person, and that covers both agricultural property relief and business property relief. And the key thing is that that million, when we're talking about a farming situation or an agribusiness situation or a business situation, that covers the value of the agricultural land, the yard, the buildings, the livestock, and the machinery. And that is why those that are lobbying for that to be changed, for inheritance tax to be changed, that is why they're focusing in on the million, because the £1 million is obviously a silly figure. You won't drive around Dumfries Galloway country, or you won't drive around many farms in Northern Ireland to add up £1 million when you do land, buildings, yard, livestock, and machinery. And as I say, up to £1 million will be exempt per person, and anything over the £1 million, it is proposed to be taxed at 20% on the excess over £1 million. Now, at this point, should recognise or pay tribute to the enormous work that the farmers' unions in each of the 4 states, the 4 nations are doing, and particularly the amount of work that the Ulster Farmers' Union has been doing in terms of lobbying both the government and Labour MPs. And as I say, were it not for the amount of work that the union is doing, then well, there would certainly be no hope of any change. So hopefully the work that the union is doing will produce some results, perhaps in the next budget. In order to get the exemption of £1 million per person, there's a number of tests or a number of things that has to be done, and this is what we're now doing with our clients in terms of planning for this. Number one, the person must have their name on the deeds of the land. Number two, there must be evidence that the person is involved in farming. And the best practical evidence of that is that the person is filing a tax return each year with farming on it. And number three, then each person's will has to be updated, because the traditional will was always that I put in my will that my wealth would pass to my spouse. Now what has to happen from April 26, the will must express that my wealth must go to the next generation. So therefore, and there isn't much time left between now and April 26, so farm families, in order to manage succession planning and to manage the inheritance tax situation, they have to, as I say, make sure that the person's name is on the deeds of the land. Secondly, that the person has evidence that they're farming, which is normally their annual income tax return. And number three, they have to visit their solicitor and have their will updated so that they express in their will the wish that their wealth goes to the next generation. Running through all of this, there's the main theme, which is maintaining harmony within the farm family and trying to encourage open communication between members of the farm family. So what we're doing at the minute is having that discussion with people and telling them or suggesting to them that they have until October to try and come up with the best option for the farm, the best option to maintain harmony within the family, the best option to encourage the enthusiasm of the next generation. And the reason we're saying October is that there is a budget in October, and perhaps there could be some changes, hopefully changes for the better. So it would be important to pause slightly in terms of just doing final instructions to solicitor until we hear the budget proposals in October. But now is the time for farm families unfortunately, it's necessary for farm families now to, as I say, look at all the options by discussing, most importantly, first of all, within the farm family, and try to have open communication and maintain harmony, and then try to move to the final options, well, option 1 or option 2, whatever it is, to meet the objectives of protecting the farm family and maintaining harmony within the family. And thirdly, taking advantage of whatever, if there are any changes that happen in October budget.
Sorry, please. Leaving to children instead of to your wife, is that a presumption that your wife will not survive you by 7 years?
Well, the idea is that what we have to do is to try and manage this £1 million figure.
Yes, but if your estate passes to your spouse, and then from your spouse to the next generation, so your spouse can then hand it to the next generation and survive 7 years to avoid.
Yeah, but then you have this £1 million. So the basics is, at the minute, as far as everyone's concerned, from April 26th, as we sit here today, the figure is £1 million. So the whole idea is to have as many individuals as possible with 1 million.
Because the 1 million cannot be transferred, that really can't be transferred to the spouse. The deceased woman. Correct. It's 1 million per person.
Provided that mother, in your example, is filing tax returns to show she's a farmer. Because there are two tests. They must have their name on the deeds, and they must have evidence that they're actively involved in farming. And the best practical evidence for that is by filing an annual income tax each year with the word farming and a figure on it. Let land, provided you are selling grass and provided that you are incurring some expenses year in, year out. That's important because agricultural property relief applies to a business. And therefore, it's important on your annual income tax return each year that you demonstrate that you're running a business. Now, sometimes HMRC do not ask for the business ID, because from a practical point of view, what to do is, when your executors file your return, claim agricultural property relief, the one thing must be on it is your 10-digit unique tax reference number, which is the number you file your income tax returns each year with. So from a practical point of view, I can assure you what to do is they look at the 10-digit unique tax reference number, and if it's clear from your annual income tax return each year that you're farming, generally speaking, that's the end of it. So that's agricultural property relief and business property relief. Second point there is that, as I said, people used to put money into pensions with a way to avoiding or minimize the impact of inheritance tax. And again, the proposal is that from April 27, money in pensions will be taxed for inheritance tax purposes at 40%. And that is a proposal to be implemented from April 27. And then another tax planning, inheritance tax planning option that is always on the table is the creation of a trust. It's always an option. Expensive to set up, expensive to maintain, very difficult to make them simple, and where you have sort of complicated document like a trust, to some people they're complicated. Where you have complications like that, that leads to confusion, and confusion can lead to disharmony in a family. So whilst the trust is always an option to consider, we try, where possible, to avoid doing a trust, because if we can manage something that is easier and simpler and less expensive and yet achieve the same objective. And then finally, if after doing all of that, using all the exemptions which I have outlined, and we still have a projected inheritance tax liability, it is possible, once we know the estimated amount of that inheritance tax, to take out an insurance policy to pay for it. Again, expensive, depending on the amount, depending on age profile, depending on health, but it is an option. So that, I think, brings me to the end of the presentation.
Well, right, we've given Seamus a quite brilliant, and he's given us an absolute fascinating kind of insight into the complexities here. And thank you so much again, Seamus, for sharing. I really, really appreciate it.